Erica Parker here, and today I am talking to buyers and how to get mortgage ready. I've got a great friend here, Paul Lamnatos with Blink Lending. Say hi, Paul.
Hello, Home Buying Nation. Erica, thank you for having me.
Yeah, thanks for coming on. I'd love to talk to you about how to get mortgage ready for my buyers. And so to start, can you kind of explain what kind of credit score people need? I know that, people hear this credit score word. And so can you explain what a credit score is and what is needed with the credit score?
Yeah, absolutely. So let's it's the best question to ask first, because without passing the credit hurdle, there's really no next step to go to. So what's another way of me saying this? You can make hundreds of thousands of dollars a year. You can have hundreds of thousands of dollars as a down payment. But if you don't credit qualify, then there's no loan option available for you. So credit is very, very, very important. What is credit, Erica, and why is it so important to us lenders? Well, at its core, credit is someone's numerical representation of their ability to do what they said they're going to do. And when a lender is looking at qualifying someone for a home loan, whether it's for $50,000 or $450,000, it's quite a bit of money, right? And want to make sure the due diligence is done so someone is able to repay the loan. But without having a credit history of showing the ability to have payment obligations and then keep them, it's very challenging. So imagine a baseball diamond, right? There's first base, there's second base, there's third base, and then the whole intention is to come home, right? First base would be credit. And similar to baseball or softball, you're not going to score if you don't get to first base. So credit, very important. Minimum credit score requirements, depending on the loan type. If you're getting a conventional loan, you need a 620 credit score or above, but that's when you're putting down 20%. If you want to put down as little as 3%, you want your credit to be at least a 640 and above. So not too big of a hurdle, right? Only 20 points more, so not the end of the world. But really where interest rates get really, really good for clients and homebuyers is when their credit score is above a 740. So 620 gets you in the door with a large down payment. 640 will get you options with a minimum down payment. If you're looking for best of the best terms, you want a 740 or above credit score.
Okay. And if someone has kind of a lower score, somewhere in the low sixes, what can they do to get their credit score better? Can you give a couple of quick tips for that?
Absolutely. So I am not a fan of credit repair. And I want to say that again, I am not a fan of credit repair. Us lenders, we are worried about your credit pass for sure, but not so much what happened 6, 10 years ago. We're really looking at the last 12 months, the last 24 months. So if you're someone who's credit challenged and you're looking at increasing your credit score, often your first inclination is, let me clean up what's previous there, an old collection or an old medical bill or whatever it might be. You can do that. My 2 cents to you is to move forward with credit and obtaining new credit. Now you might be going, well, Paul, that's pretty easily said, but doing it's different. I have a 570 credit score right now and Visa and MasterCard, they're not knocking at my door to give me a credit card. So what are my options? Secure credit cards. If you're not familiar, Google secure credit cards. And the short version is this, you give $500 and then the credit card company gives you a $500 credit card. And now what you're doing is you're building credit. And over time, you're going to start getting the mailers that you've gotten. Please take this credit card and please take this credit card. And you really want to manage 3 to 5. And in doing so, you don't need to go out and buy new shoes or buy new furniture to take on new expenses, right? Every month, Erica, you have a cell phone bill. Every month, you have an internet bill. Every month, you put gas in your car. So when I was building my credit, I allotted a credit card for each one of those items. And then once I charged it, I just paid it off with my debit card. Because what I realized I was doing all along is I was paying for my cell phone bill, I was paying for my internet bill, and I was paying for gas with my debit card. So even though I was making those payments on time, I wasn't getting any credit for it, right? So in getting the credit cards and having those pay already existing expenses I have, and then having those paid off has really been impactful.
Okay, great. And so another question I had was, what amount of work history must a person have? Is work history a big question or a big issue with getting a mortgage?
So you're sliding right onto second base with income, huh? And so yeah, work history is important, and 2 years is the direct answer. Now, I want to elaborate a little on that because someone could be 17, 18 years old, 19, they just graduated high school and they've got a job, they're choosing to skip college and they want to buy a house. So they don't have a 2-year work history, right? Well, really they do. They were in high school. So we can take their previous schooling as work history so long as there's not a large gap of unemployment. And the same goes for college. So let's say you are 17, 18, 19 years old, and instead of bypassing college and buying a house, you choose to go to college. And now you've graduated college and you want to buy a home. Well, you don't have 2 years work history, except you do. Your college, 4 years or however many years you went, that can serve as work history. And then going to use your new pay going forward as income. There's a big trick to this though. It has to be W-2, either salary or hourly income. It cannot be, I went to college or I'm starting my own business after high school.
Yeah, so that's kind of my question as an entrepreneur, and a lot of people that are out there having started their own businesses. What can they expect and what do they need for the ability to get mortgage ready and the ability to get a mortgage?
So the quickest answer is marry well. Make sure your spouse has a W-2. So there's a few ways this goes, right? If you're in the same line of work, so I am an engineer and I've been working for a company for 4, 5, 6 years. And now instead of being W-2'd with them or salaried with them, I'm contracted. So I literally sit at the same desk, I do the same job, but my pay has changed from a W-2 to 1099. That home buyer would have to wait until they have 1 year of filed tax returns. So that doesn't mean being at the job for 1 year, because you could be there from October to October, but you've only filed income for the 2 months of the previous year. Now we need to wait for the full calendar year to pass so you can have a year of filed tax return income. So that's when you're going from the same line of work into the same line of work. Now, let's pretend you're someone in oil and gas and you've recently decided to get into real estate and become a real estate agent. Well, that is not the same line of work. So in order to get qualified for conventional financing or FHA financing or even VA financing, which all this, what this means to the home buyer is the best of the best financing available. These are low interest rates, fixed for 30-year periods with no prepayment penalties, just what you want, right? It's the interest rates you hear on the news, see online and on TV, et cetera. And so with these types of loans, you need to have 2 years of filed tax return for qualifying income. Anything less than that, as it turns out, you're going to have to wait. Now, that's again for conventional FHA or VA financing. There is other types of loans out there with significant down payments, 20, 30% down, that do allow for self-employed clients to get financing. The difference there is instead of the rates being, in the high 2s, low 3s, you're looking in the mid 6s to mid 7s. So you're paying for that risk absorption there.
Okay. So we've made it to second base, and now can you explain kind of the debt to income ratio and what people need to have or what they need to see or what you would like to see as a lender in their debt and in their income, and what they need to consider with that?
Yeah, absolutely. And very, very important component of the loan qualification process is what we refer to as DTI, or known as debt to income. And that is as a ratio. So it's what are your debts to your income as a ratio. And that percentage does not want to exceed 50%. Now, you might read things online that say 37% or 43%. But know this, if your debt ratio is less than 50%, you have a far better than puncher's chance at getting qualified for a loan. You're all but certain to, so long as you meet the credit criteria, and then what we're going to talk about with the third base, which has to do with assets. Now, debt to income ratio, what does it take into account? It takes into account your living expenses from your home, principal, interest, taxes, insurance, and or any HOAs that are applicable. What it does not take into account is your electric bill or your cable bill or your internet bill or your health insurance bill. It does take other secured debts into account, like your car payment, a student loan, a child support obligation, a previous tax obligation. So anything that you may owe that involves the government, credit cards, car payments, or housing expenses are factored into your debt to income ratio. Again, things that aren't are cell phone bill, groceries, gas, your everyday. And why those aren't factored in is because the other 50% is left for that, right? So if you're someone who, let's pretend, makes $10,000 a year, 50% of that, for easy math, is $5,000. We as lenders don't want your total monthly expenses to exceed $5,000. So your house payment, your car note, your credit cards, and all those other expenses I mentioned, we add those together. If you're less than $5,000, thumbs up. Now, you may not want to do that calculation and sit there and add every bill you have and do I have 50%? Do I not have 50%? So two quick solutions for that. Call a local independent mortgage company and ask them if you qualify for the loan and how their debt to income ratios work. Quick sneak is whether it's a local independent mortgage company or a mainstream Wall Street bank or a smaller credit union or anything in between, when it comes to conventional financing or FHA financing or VA financing, we're all playing by the same rules. We lenders play by the same set of core rules, that is. Depending on the lender or bank, there might be additional rules that come into play. So here it is, conventional financing says you can have a 50% debt to income ratio. But you walk into the big bank and say, hey, I'd like to get a loan. They say, well, we need you to have a 40% debt to income ratio. That is not everyone's rule. That is their rule, their additional guideline on top. A good mortgage term for this is called overlay. So you could ask, hey, mortgage company, do you have any overlays? And if so, what are those? So the intention of this video is not to turn you into a loan officer, but to give you some sneak peeks as to what to expect when going through the qualification process. So that's part one in manually writing everything down and reaching out to an independent mortgage company. An easier way to do it is, do you make more than 3% of the purchase price per month? So you're buying a house for $200,000. 3% of that is $6,000. Do you make $6,000 or more per month? And when I say you, I mean whether it's an individual that's buying a house or a married couple that's buying a house, or father, son, mother, daughter, joint applicants, whomever, is you would look at the combined income of the applicants when buying the house. So that's debt to income ratio. If you're below 50%, pass go, and good luck heading over to third base. So third base, assets, down payment requirements or reserve requirements. What are those? In down payment, you can put, as a first-time home buyer, put as little as 3% down if you're not a veteran or if you're not buying in a rural area. Why do I define those two things, or mention those rather? Well, because if you're a veteran, you qualify for 100% financing. You don't have to put a down payment, and you're likely well aware of that with your VA loan. If you're not a veteran, you might think that 100% financing is not available to you. Well, it actually is. There's a special program called USDA. This is a loan type that is to encourage buyers to buy in rural areas. So think of outside and country areas. Now, you'd be surprised about how many houses actually fall within the USDA map, for a lack of a better term. So you could go to Google USDA map, and depending on where you live, it'll tell you these areas qualify for USDA financing. And the great news there is it's 100% financing. So if you don't want to put a down payment, join the armed forces or buy out in the rural areas. If those two things aren't an option, then 3% down is the route you want to go with conventional financing. FHA financing allows for 3.5% down. So not much more, right? It's just a 0.5% higher. Eric, I'm a big fan that if you have the option between a conventional loan and an FHA loan, that a conventional loan is far and above better than an FHA loan. But with an FHA loan, you're still getting a fantastic loan. And I don't want to take away from the FHA loan. I really just want to add to how great a conventional loan is within the two. So 3% down, 3.5% down as minimum down payments. And reserves was the other question you asked. Reserves, think of this as another way as rainy day, right? What happens if? What happens if there's a job loss? What happens if there's an accident? What happens if there's the unexpected that comes up? How many months of reserves do you have to make the house payment? So if your house payment is $1,000 a month and you have $6,000 in your bank account after closing, well, then you have 6 months of reserves. That is looked at very favorably by us lenders. With FHA loans, you can get away without having any reserves. So whatever money you bring to closing, so long as you're employed and the monies you're going to be bringing in can take care of the payment, FHA will say yes to that loan type. Typically, conventional loans want you to have 2+ months of reserves. So the safety belt in all of it is 6 months, although not a requirement. And I just want to repeat that. It's not a requirement, but it does help you out in what we term compensating factor. So if there's any gray area with anything to do with your loan, first place us lenders go to is what happens if bucket. And that if bucket, the more money's in there, well, the better it is for us. Okay. So that covers third base.
So what's home plate?
So now that you're good, right? And it's in all home loans, us lenders, we're looking at two components. We're looking at the borrower, the home buyer, and then we're looking at the property. So the first three bases have everything to do with the client, right? The buyer, credit, income, and assets. And once all that's been cleared, now the only thing left to do is for you, the realtor, to go out and finding them an amazing house. And once you do, coming home, we want to verify the property we're buying. Now, there's really four elements we want to verify. First being title. See, as a home buyer, I don't want to buy a property that I'm going to inherit previous liens that come with the property. Those previous liens could be things like property taxes that weren't paid for, or a plumber did some work on the house and didn't pay. The homeowner didn't pay the plumber, so now the plumber put what's called a mechanic's lien on the property. So when I, as a home buyer, am buying a house, or when you, as a home buyer, are buying a house, you want to make sure that you're buying it free and clear of all previous liens. So that's why you'll get title insurance. You're getting insurance to make sure the title is clear of all previous liens. So just to keep this, you're leading off a little bit, right? The next is we want to take a look at the appraisal, the value of the property. Your realtor, your mortgage lender, we want to make sure that you're not buying a house that's worth less than what you're buying it for, right? You don't want to pay more for something than what it's worth. Unless there's some, well, it's right next to my mother's house, or it's right next to my best friend, or there's something so compensating or so appealing to you that you're willing to spend a little more. But in a normal world, if a house is worth $100,000, that's what I want to pay for it, or I want to pay as little as possible. So the appraisal makes sure that you as a buyer are not overpaying for a property. And let's say you are trying to buy that house for $100,000. and then it comes in and it's actually worth 90,000. Well, you now have evidence to where you can go back to the seller and say, look, I really like your house, but you're saying it's worth 100. This professional over here is saying it's worth 90. What can we do here? And you have three options. The seller lowers the sales price to 90. You pay the full 100,000, which means you cannot borrow that 10,000 from the lender. You would have to make up that difference. So we would give you a loan based on the $90,000. You would be coming to closing with the additional 10,000 on top of your already agreed upon down payment. The third option is you and the seller can come to an agreement, right? So they either drop the price, you pay it all, or you guys come to an agreement. Third is survey. This one's often overstepped, Erica, and I think a survey is so important in that it tells me what I truly own. We bought a house, my wife and I bought a house at the end of last year, and when I looked at the survey, I realized that a quarter of my yard is actually not my yard. It belongs to the city. I'm on an easement. So knowing that is pretty important. I knew that ahead of time. So I could make the determination, is it still worth me buying it? Because what if the city does come in and take away a quarter of my yard? I don't want that to be a surprise, right? I also want to make sure that the neighbor's fence is where it's supposed to be. Because what if the neighbor's fence is 4 feet into my yard? Well, now my yard just got 4 feet bigger, right? Because I can say, hey, this is what I own and I'd like the fence line to move. If there's any power lines or city encroachments, these are things I want to know about before I sign the dot that I'm going to pay back a mortgage for 15 to 30 years or however long it is. That's a pretty big commitment, right? Lastly, homeowners insurance. You want to make sure that the property is properly insured. Last thing you want to do is buy a house for $100,000. Heaven forbid you have an accident and the insurance company gives you a check for $30,000. And now you're stuck having to cover the remaining amount. So mortgage companies will make sure that you're properly insured. And once you've selected the house, we've gotten clear title, the appraised values come back and it checks out. The survey is all up to speed and you're buying the property that you think you're buying and you're properly insured. Well, here are the keys and happy backyard grills and summer vacations and all that good stuff.
Yay, home run.
And everybody's cheering. Right?
High fives. Well, that is really helpful. Thank you, Paul, for joining us and explaining kind of all the things that go into getting mortgage ready and pre-approved so that people can kind of understand that and get that ball rolling even before they start looking and before they even come to me as an agent and you as a lender. So I really appreciate you taking the time and explaining that to all the buyers out there.
Well, thank you so much for having me. I do look forward to us doing more of these and coming up with different topics to educate buyers, not just on what to expect during the process, but before, after, etc. So let me know and I'll make sure to fill up the coffee.
Yes, thank you. Bye, everyone.